As of Friday, December 26, 2025, the market for Strategy Inc. is currently preparing for the final full trading session of the year, with the stock price standing at 158.71 USD, marking a modest intraday move of plus 0.83 or 0.53% in early activity. While the broader market sentiment often views this company as a simple proxy for the price of Bitcoin, the reality unfolding behind the scenes is far more complex and arguably more interesting than the simple tracking of a digital asset. Most investors look at the ticker MSTR and expect a direct correlation to crypto swings, but the actual development that should catch your attention today is not just the coin price, but the massive $1.44 billion cash reserve the company has quietly built to insulate itself from the very volatility it has become famous for. This move signals a fundamental shift in how the leadership manages its balance sheet, moving away from a pure accumulation model toward a more sophisticated treasury strategy that looks more like a specialty finance firm than a software company or a crypto whale. The common belief right now is that the stock is merely suffering through a late-year crypto sell-off, with Bitcoin dipping roughly 30% from its October highs. The expectation is that until the digital asset recovers, the stock will remain stagnant or continue to slide. However, the deeper analysis suggests that the company has actually strengthened its defensive posture. By establishing a substantial US dollar reserve, the firm has effectively neutralized one of the biggest bear arguments, the risk of being forced to sell its holdings during a downturn to meet interest payments or preferred dividends. This is a nuance that many retail traders using a simple online investing app or a basic individual brokerage account might overlook while focusing solely on the daily candles. When you compare this to how people trade Apple stock or Nvidia stock, the volatility profile is obviously different, but the institutional engineering here is becoming just as rigorous. Looking at the recent momentum, we have seen a significant amount of institutional activity as the year winds down. Large players like Vanguard and Capital International have been adjusting their positions, with recent filings showing that despite the 54% decline in share price over the past year, these massive institutions are actually increasing their share counts. This creates a fascinating tension. The retail expectation was a straight path to the moon following the crypto highs of 2024, but the reality is a brutal 52-week range that saw the stock fall from a peak of 457.22 down to its current levels. This kind of drawdown usually scares off the weak hands, but the trading volume, averaging over 18 million shares a day, suggests that the liquidity is being used by savvy investors to build positions while the narrative is messy. If you are using a platform like Robinhood Stock Trading or Interactive Brokers to follow these movements, you've likely noticed that the correlation between the stock and its underlying assets has started to decouple at key intervals, particularly when the company announces new debt or equity offerings. The company's performance in 2025 has been defined by a relentless pace of Bitcoin accretion, recently reaching a total of 671,268 coins. This represents roughly 3.1% of the total supply that will ever exist. In the middle of December alone, they added over 10,000 BTC. But here is the part where reality challenges the expectation. Even as they buy more, the earnings per share guidance for the full year has been revised to a range between -$17 and -$19. To the average person looking for investment help on various investing sites, a negative EPS of that magnitude looks like a disaster. But to the smart money, this is an expected byproduct of how the company accounts for its digital assets and its aggressive use of leverage. They aren't trying to run a traditional profitable software business anymore. They are running an experiment in capital markets at a scale we have never seen. Institutional investors who use professional tools like the Interactive Brokers platform or Fidelity Wealth Management Services are paying close attention to the BTC yield metric. This is a term the company created to describe the ratio between its Bitcoin holdings and its diluted shares. Even when they issue new stock to buy more Bitcoin, they are doing it at a rate where the amount of Bitcoin per share actually increases. In 2025, that yield reached a staggering 26% year to date. This is the reality that contradicts the surface-level price action. While the price is down, the intrinsic value per share, measured in digital gold, has actually grown significantly. This is why the institutional ownership remains high at nearly 60% despite the rocky year. They are betting on the accretion of the asset, not just the quarterly earnings report. Comment below how many shares of Strategy Inc. you currently hold and whether you think the current cash reserve is a smart move or a sign of fear. It is always interesting to see if the community is focused on the long-term accumulation or the short-term price swings. The business model itself has undergone a massive rebranding this year, officially changing the name from MicroStrategy to Strategy Inc. to reflect this new identity. While they still provide enterprise analytics software and have been integrating new AI-powered features, that segment of the business is essentially a break-even operation. It provides the brand and the corporate structure, but the real engine is the treasury. They've even received a B- credit rating from S&P Global, which is a big deal for a company with such a volatile balance sheet. The rating agency noted that while the business focus is narrow, the company has demonstrated a remarkable ability to access capital markets even when the crypto market is under stress. They've moved beyond just using a simple Fidelity brokerage account or a Robinhood app to manage assets. They are now issuing perpetual preferred stock and convertible notes with maturities stretching into 2029 and 2032. When you look at the competition, the narrative becomes even clearer. Firms like Mara Holdings and Riot Platforms are often lumped into the same category, but their reality is fundamentally different. Those companies have to deal with the high costs of electricity, hardware depreciation, and the physical risks of mining. Strategy Inc. has bypassed the industrial headache and focused entirely on the financial layer. They are using the software business as a stable base to launch these massive capital raises. This is a level of self-investing on a corporate scale that is unprecedented. While someone might use a SoFi robo-advisor or Schwab Intelligent Portfolios to manage a personal retirement account, this company is essentially acting as a giant, leveraged, actively managed Bitcoin fund that has the unique ability to issue its own currency, shares, and debt to acquire more of the underlying asset. The institutional pressure is also mounting from the threat of index exclusion. There has been talk in the latter half of the year about major stock indexes potentially excluding companies that hold large amounts of digital assets on their balance sheets due to volatility concerns. This is a risk that could lead to forced selling and is likely one reason for the current price pressure. If you are managing your own portfolio through Fidelity Investments or a SoFi investing account, you have to weigh this structural risk against the potential upside. If the company is kicked out of a major index, the temporary liquidity drain could be significant, regardless of how much Bitcoin they hold. This is the reality check that tempers the expectation of an easy recovery. As we look toward the future, the catalysts for 2026 are already taking shape. Citigroup recently issued a very bullish forecast for Bitcoin, targeting $143,000 over the next 12 months. If that reality manifests, the leverage built into the MSTR balance sheet could act like a slingshot. Conversely, the company's own guidance assumes a potential year-end range for Bitcoin between $85,000 and $110,000. This wide range reflects the honesty of the management. They know they are at the mercy of the market, but they are building the boat to survive a storm. They've even hinted at using their $1.44 billion reserve to fund dividends if things stay flat, which would be a huge shift in how they reward shareholders. If you are using the Fidelity mobile app or the Robinhood Investments interface, it's easy to get caught up in the green and red of the daily charts, but the real depth of this stock is found in the debt-to-equity ratio, which currently sits at a very manageable 0.16. For a company that has borrowed billions to buy a volatile asset, that is a surprisingly conservative figure. They have managed their maturities so that no major tranches of debt are due in the immediate future, giving them the time that most individual traders lack. This is why the comparison to something like a Fidelity trading platform or Interactive Brokers is so relevant. The company is essentially trading the market with a much longer time horizon and much deeper pockets than any individual could. In summarizing the current situation, the expectation of MSTR as a simple Bitcoin proxy has been shattered by a year of complex financial engineering. The reality is that the company has become a sophisticated treasury